Well, thanks for tuning in to Talking Point. I'm your host, Niraj Shah. It took some guts for select people to be overweight on financials when the whole world was talking about how asset quality issues will come back and spike up post the moratoriums were over. Well, one institutional equity setup actually went ahead and gave their overweight call, even purely probably backing the valuations and the overall strength of the franchisees, because the moratorium and other issues probably came to the light later on as well. So Spark Capital, the institutional equities team, did have an overweight there. That aside, the conversation today with Ganeshram Jayaraman from Spark Capital would be about what is it that their current stance is now that we are no longer at those distress levels, but almost back to pre-COVID levels, maybe 1,000 points away from all-time highs. So he joins in right now today on the Talking Point to talk about all that and more. Ganeshram, good having you. Thanks much for joining in. Hope all is safe.
All well. Good morning, Neeraj. Good speaking to you.
Likewise. So Ganeshram, it's interesting that we are talking today when the Bank Nifty has shown some exemplary strength over the last few days, and people are now talking about how the valuation discount between the two indices can narrow. But as I read your strategy notes to the last few months, I reckon that you've been bullish on the financial space. So I want to start off with that first, then get on to the other things, because this is so hot right now. Yeah. What made you have a positive outlook back then when the future ahead was clouded, and now that it is worked out, what is your stance?
Yes, see, the primary call which we took in March, we waited till March. For 2 years, we were underweight banks, and we kept telling we are concerned with some banks, we are concerned with a likely pain in the NBFC space, the real estate sector, and we recommended underweight, very safety first kind of banks till March. And we thought those issues kind of blew up in March, and we then saw the COVID issues come and valuations get literally destructed, and the street was concerned about due to COVID lockdown how this could impact asset quality. I've been tracking banks for 20 years, and we have not seen anything like this. But the closest was 9/11, and how the events took shape after that, especially in the US. And the learnings for me was when you have asset quality pain, you split it into three different buckets. One is an event-led asset quality deterioration. Second is a cyclical asset quality pain, and third is a structural pain. Okay, and 9/11 was a good example of an event-led pain. We have seen cyclical challenges, say, on commercial vehicles or real estate over the years. Structural pain was the infrastructure challenges, which we saw, say, between 2010 and 2000, pretty much till today. Okay, so I think we need to distinguish between the three very importantly. And event-led pain impacts income, but doesn't impact the underlying assets or the wealth. Cyclical impacts a bit of both. Structural challenges destruct all two. Pretty much the entire company. So how we need to look at asset quality deterioration and likely impairment to book values changes in each scenario. That's one. Secondly, see, the bigger point which we said was when we do a stress test of banks' financials, and how the moratorium book as it appeared in March and at the peak in March, how that could take shape. Our judgment was it will get broken down into 6 different buckets. Okay, first bucket is, and moratorium is available, consumers or corporates, borrowers will hoard cash, and once the moratorium ends, they will start repaying. That's bucket one. From their own sources they repay. That's bucket one. The second bucket is when banks take a judgment that based on the borrower's track record over the years, they take a judgment, okay, his income is impacted, but his assets are good, underlying security cover is good, so we can give him a fresh loan to help him tide over the current problems, so that he survives. His track record gives banks the confidence that you can back him. So in some form, what banks do is give him a new loan to help him tide over the last 6 months cash flow issues or the next 6 months cash flow issues. So they, in some form, they knock out knock off the outstanding interest or installments and give him a new loan in some other garb of a fixed loan or ad hoc loans or whatever names you call it. That's the second bucket. That will reduce the moratorium pain, translating into either an NPA or restructured assets. Third is Reserve Bank allowed something called funded interest term loan a couple of months back, where working capital facilities of even medium large corporates will be converted into a term loan. So that will also bring down the moratorium book in proportion quite sharply. And the fourth is what the central government allowed as the credit guarantee scheme for MSMEs to the tune of about 3 trillion. So far, it's about 1 trillion, but you will see that accelerating as the moratorium ends end of this month. So we see that also to reduce no the effect. And you will not see 3 trillion, by the way, because banks will tell the borrowers, I'm going to give you, if you're, say, a borrower has 100 rupees as outstanding debt, they'll say, I'm going to give you 15 rupees, but you've not paid interest for the last 3 6 months to the tune of 5 rupees, so I'm going to give you net credit of 10 rupees to your bank account. But what it does is the outstanding dues get cleared, and that will bring down the asset quality potential pain. So there are various options which banks have, and operating understanding of banks built over years help you take a call that this is how the translation, the moratorium book will get transformed as time goes. And the street wasn't convinced about this. They saw huge moratorium numbers, which they translated it into either a restructured or as a delinquent asset, and they said book values will get impacted, and the stocks fell 50, 60, some cases 70%. So of course we need to take a judgment on the quality of the loan book, on the management team, and we took that call and we said get overweight on banks because the valuations looked very attractive.
The question therefore is, Ganeshram, that what happens next? Because the first part, and not the easy part, taking the call was the difficult part, but let's just assume that from the valuation perspective, the easy part of the gains are made. Now, do you revise the call in that you don't play them only for the mispricing of the stress that the street was doing, but try to now bet on which quality franchise or which franchise will be able to ride over the next 2 3 years? Or do you believe the beta of making up, the beta of taking advantage of the street's mispricing still exists?
It still exists because the street is not fully convinced yet. All my conversations with the various institutional investors, that gives me a sense that the street is still skeptical on how this asset quality will take shape, because this is a once 100-year issue, and whether the far-reaching consequences of this is still understated, I mean, it's still kind of unknown. So in some form the skepticism exists. I'm not saying there's going to be no pain, by the way, but all I'm saying is it's going to be much less. And more importantly, banks have created shock absorbers to absorb that pain in the form of the March quarter and the June quarter, the COVID provisions or the excess provisions, the floating provisions, or they've raised equity, they are sitting on unrealized gains in their treasury book, or the ensuing 3 4 quarters of earnings as well are a buffer. So what we are basically saying, the buffers offset the likely pain, and the pain itself will be a lot less than feared. This makes us believe that there is still a lot more upside on a bunch of banks where the street's concerns still exist.
Very interesting. In which case, are you looking to buy out those banks where the street is arguably more concerned? And it's a bit of a repeat of what you just said, but the difference that I'm trying to figure out here is that there are some banks in which the belief of the stress being very high, that belief is also very strong. And then there is a set of quality banks, the likes of HDFC, Kotak, etc., where the street believes that even if there is stress, they will tide over it better. So my question is, which lot tactically would you bet on in the current scheme of things?
See, we will always choose a middle path. Okay, that's always been our preference, because on one hand, the 5 times book kind of franchises, we don't see they could give returns in the short term, but we don't see long term return creation in excess of 15-20% compounded per annum potential available. There is a risk of derating very live as growth rates kind of moderate because of scale. at the same side, we don't want to go the distress side and take abnormal risk, and that's not what we are paid for. So we will choose a middle path in terms of the thereabouts of one time book, not 0.5 times book, but the one time book kind of banks where there is some concerns, the governance is not question mark, the asset quality, while there will be some deterioration, it's not going to be an implosion. So we will kind of choose the stocks where our comfort on management is still there, comfort on the asset quality is not it's not like it could potentially blow up, and this could turn it around completely. So we will choose our bets very carefully, but there are enough more, I can tell you. Even in the large cap space, there are banks where that you can take outsized positions because the returns could be very attractive.
Very interesting. The one small follow-up, and I don't want to make this only a banking conversation, but since you mentioned about the expertise that you have on financials, I just am tempted to ask you, the counter to this strategy, Ganeshram, could be, and 2 points out here. One, that the big might get bigger is a real possibility, especially because the strong balance sheets will have growth capital, whereas the slightly weaker balance sheets will, if not survival capital, managing capital would be the availability. They won't have growth capital. That is part one of my question. Part two of my question is this theory that the banks which were trading at higher valuations but they had stronger balance sheets might actually get even higher valuations in a post-COVID world, simply because while the Indian banking sector is now well established, if there are three or four which come out with flying colors through a stress test like COVID-19, then they anyways deserve a higher multiple.
Yeah, no, that's so true. We will always have some of them where the management quality, the underlying rigor on underwriting is good. So we will always have a few of them. Some of the names you mentioned will always be there. They're kind of all weather managements, as we call it, not just a good weather. They survive in all kinds of weather. So well, definitely yes. But the point I'll highlight one important point to you, which is the regulator is increasingly, the Reserve Bank is increasingly telling banks to manage with 15% tier 1 capital adequacy. We think over the medium term, as when I mean medium term, I'm looking at 3-year horizon. We believe that the ROE profiles as a result could be much lesser in this cycle than the previous cycle. So when we are paying 3 times plus books for any bank, we need to keep cognizance of the fact that the price to book multiples this time around will not go to what we saw in the last 10 years, where we saw ROEs go even in excess of 18-20%. I don't see that happening. We think it will be more likely in the 15% range, even for the better banks, given that they will most likely be overcapitalized, and that will have some bit of an impact on how valuations or exit multiples will likely take shape. That of course will take time for this whole thing to settle down. But in the short term, there can be what you rightly said. If in a tough environment you have come out unscathed, how well you can do well in an improving environment, and that's possibly will take some of these valuations higher. But we work with a 3-year exit multiple mindset as well, and that gives us some bit of skepticism to extrapolate this valuation and just say the stock trades 5 times book today, 3 years later it will take 5 times book, and as a result this is the multiple. That we need to shy a little away from.
I get your point. Okay, fair call, Ganeshram. So I'm guessing that you are not averse to say an HDFC or a Kotak Bank, but maybe your preference list in terms of fresh purchases might be a list which is slightly different than that. Okay. What about the other financials, NBFCs and non-lending, and then we'll move on to the other parts of the market, Ganeshram. Are you bullish on the non-lending financials because they will not have asset quality risks and the growth is out there? Or would you believe that a bet on lending financials, NBFCs, might be a better bet at the current point of time?
Very, very selective NBFCs, very choosy. In fact, the funnel will be a lot tighter. Our screens will be a lot stiffer. But there are maybe one I can say at best, and that too is more cyclical bet than a structural call at best. So more selective on NBFCs for sure. I think banks will disproportionately gain market share from NBFCs in the ensuing cycle. On non-lending financials, general insurance is our favorite in that pack. We think general insurance is something like how we saw banks 15 years back, where it is under penetrated segment, and state-owned lenders or state-owned insurers incumbents, which means there is a long runway for growth, and both in terms of penetration and in terms of market share gains, and for profitable growth to be garnered. So general insurance is our preferred pack within that space. We are more skeptical on life insurance than the street is. We firstly don't believe that it is as underpenetrated as general insurance is, contrary to the street's belief. I'll state it with one example. The penetration of life insurance was more in 2011 than it is in 2020, which means not only is it more penetrated, it is more cyclical. It goes the way the life insurance industry in India is structured. It tends to mirror markets more, so it goes up and down with markets more often. So we think life insurance is one, cyclical, not structural. Secondly, it's more penetrated than it is perceived to be. So these two are one reasons, but there are many other reasons as well. We think the new tax rules, the income tax rules which changed in the budget, it's little forgotten now because it's kind of off season. It's only when we go into the Jan Feb March we'll understand it a little more. We think that the new tax rules will have an impact on growth rates. We think the competition, the refinance rates, there are a whole host of issues. I mean, that itself is a 10-minute conversation just on talking life insurance. But long story short, we think life insurance is little more. We that's done well because investors have moved from banks to life insurance to hide. We think that can also reverse, talking more technical language.
Okay. Well, Ganeshram, I must tell you that I would look forward to that 10-minute, 12-minute conversation the next time we speak. So we could actually do a whole conversation on your thesis about life insurance versus general insurance the next time we speak. This is 27th of August. We could well do something end September or beginning October. But I'm very happy to do that because I have all the time in the world to discuss quality conversation. Let me tell you that.
Sure.
Okay. But yeah, since today we decided that we'll speak about a lot more than just specific topics, a couple of other things as well. I was reading your strategy note on July, 2nd July to be precise, right? Wherein amongst other things, you mentioned about how rural India was a lot less affected than our metros were. Now, it was true then. I reckon it is no longer true now as we come to the end of August. It's been about a 2-month period. And I think rural India and tier 3, tier 4 non-metro cities are now almost as impacted, in certain cases probably more impacted than metros too, on a percentage per person basis. So therefore, do the dynamics of what institutional investors might bet on change in such a short period of time, simply because the dynamics of how the COVID has spread and how the micro lockdowns are happening have also changed?
To an extent, you're right, but when you're referring to tier 2, 3, 4 towns as well, they are actually semi-urban still in classification. When I meant rural, I'm looking at the agri economy more. I'm looking at so what really happens there is the dispersion of population is a lot more. It's a lot more spread out. So that leaves the scope for the lockdowns to be actually implemented lot difficult. And I can tell you, we've been driving down even in the last 10-15 days across, even if you drive down 100 kilometers off the cities, you're realizing that there isn't a lot of lockdown impact seen. It's BAU in some form there, in some form. I'm not saying it's 100%, but it's carrying on. And there are 4 reasons why we always, or how we always evaluate rural economy. One is how the farm economy is operating in terms of farm prices, farm output. We are currently in a little bit of a purple patch where the farm output is very good for the second year in a row, and farm prices are up now for second crop in a row. So that is helping the rural farm economy. The second is how the government is spending on rural in terms of food crop procurement or food grain procurement as one, or rural spend on infrastructure like it could be on roads or electrification or railways or in some form government infra spend in rural economy, and Narega is part of it. So we are seeing some very good data points traction there on how the central government spend on rural is actually helping the recovery, especially in the lockdown last 2 quarters. That's the second driver. The third is gold prices. Okay, gold is up some what 70% in the last 24 months in rupee terms. So that's a huge wealth effect, and two-thirds of Indian gold or two-thirds of gold loans by banks and NBFCs are in the hinterland, and that is another wealth effect. And what you're seeing now as gold loans growth, which is why you see the gold financing NBFCs are at all-time high valuations or stock prices. That's because the tailwind is very high, and that's a wealth effect percolating into the small households, small shopkeepers, and that's a shock absorber. The fourth is real estate and the wealth effect due to that, where we are not seeing anything today. So, what drives rural economy? There are three out of four drivers which are doing pretty well today, and that will hold the rural economy in good stead in this cycle. Mind you, you'll have to play rural on 12-month basis. It's never a buy and hold strategy that you can have in rural. Rural is always going to be cyclical. But
I
yeah,
get your
for
point.
now, 12 months, we have been saying rural will recover. Now, I remember writing last October that rural cycle is beginning to look up. We are now end of 10th month, and that's continues at least with the next 1 year view for us.
Okay. Last couple of questions on the two topical points today, Ganeshram. One of them, since you spoke about rural, etc., I want to put in a question around two-wheelers. There is this much buzz about a GST cut coming in as well, which somehow I find it difficult to see if it gets implemented today itself. Let's assume it doesn't go through, but rural is picking up. Management commentary is saying that sales are almost back to pre-COVID levels. I think Royal Enfield said that yesterday. My question is, are you optimistic about the two-wheeler sector in India?
Cyclically, yes. Okay. And also you need to be on two-wheelers. It is a pretty well penetrated segment, so you need to pick your choices pretty well in terms of what kind of companies can gain market share, what are their product suites, how well EV is will come at some stage, and markets will will reckon it in their terminal values that two-wheeler space is vulnerable for a disruption on EV sometime in our horizon, and it will not have an impact on earnings, but it will have an impact on valuations. So you will never see this sector go back to 25p or thereabout. So it is going to be watered down to
Okay.
some extent. That's one. But cyclically, two-wheelers, especially in the agri belt, so especially in northern, central, and maybe even eastern parts of the country, the this bicycle to two-wheeler demand shift, the agri economy recovering, those will help earnings. So western and southern parts of the country, you will two-wheeler demand, companies which are stronger distribution there or more biased towards that part of the country will not see growth at a pretty high level. So our preference is entry level, northern, central, East India biased auto two-wheeler companies, and it's more cyclical. I will take a 12 to 24-month view and not look at it on a buy and hold strategy, and a fair bit of the returns have actually already come in this space. I'm not saying it's all done with and you will not want to take it out. There is still a lot more juice left, but it's not attractive to get in today to build a fresh new position.
Okay. One last thing is on real estate. There is, I mean, a booster shot given by Maharashtra, but that notwithstanding, we have a regulator, and a lot of people say that what SEBI did to the financials by being the watchdog, RERA could do to real estate, and specific real estate companies might actually become really large and stronger and wealth creators over the next 10 years. Any thoughts there?
See, after
Both
about
the near
8
term and the long term. At the near term, the booster shot that has been given, can it help?
Sure. Yeah. See, after 8 years, where we kept telling 2012, well before the problem started, we were maybe too early. Then we kept telling real estate is in doldrums. After all these years, last month, July, we said, of course, we didn't see stamp duty rate cuts coming, but our reasoning was different. Our reasoning was, we said the NRIs, non-resident Indians, will start driving demand for real estate in urban India. And actually, it was more non-Bombay that we were looking at, because the rupee is depreciated from 47 to 75 in this horizon. The interest rates have come down, give or take 150 bips. The property prices have been flattish through this period, pretty much across the country, in some cases down. So, seen in terms of dollars, for say a non-resident Indian, we thought the property is down 40% vis-a-vis how it was in EMI terms, how it was in 2012. And when you go back last 25, 30-year data, whenever the rupee is depreciated due to any global disruption, you can go back to 9/11 in 2001, you can go to the financial crisis, you can go to taper tantrum in 2013, remittances into India go up because interest rates go down globally, and that the spread between the rates in Western world and India goes up. That and the rupee also depreciates, so that converts, the rupee value of the same dollar goes up. So it's in some form a carry trade, and that results in a flood of non-resident Indian remittances. And inevitably, with a 6-month lag, we have seen that go into real estate. That's been 30-year track record telling us, and we saw that. And we said, we think the unsold inventory could be a very juicy entry for a lot of these money which will come in from NRIs, and we are seeing it in the last 3-4 months. Non-resident deposits have gone up, and we believe this will start percolating into real estate by the end of this year, early next year. So that's one thing. As the second point is, as you started saying, the industry is consolidated a lot more after RERA and the destruction in demand. Demand is down 30-40%. In fact, new projects launches are down 50%. Supply is down. That's what I meant as supply. The new projects coming down is brought supply down a lot more. So if you buy well capitalized, credible managements, mind you, there are not too many in that sector, but there are a few. So we will be very choosy on selecting the balance sheet, selecting the management, right micro geographies. But even if you do it, we can see one or two credible names which have done a very good job over the last decade in preparing themselves for the upcycle. And we think that time has come. Now, you asked the question whether it's a next decade. Honestly, we will never see real estate like a decadal view, because for us it's more cyclical always. It's not a buy and hold sector like how you will find some banks or consumer companies or even some auto names. So we will auto is though a little cyclical, but there are good names there, buy and hold. But real estate will always be with a 3-year view, where you take a medium term cycle into consideration and recommend clients accordingly.
Okay, Ganeshram, this was lovely talking today. Thanks for the lowdown on the thesis on banks and financials. But I look forward to maybe a detailed conversation on insurance at some point of time and more so. But thanks so much for talking today.
Pleasure's mine. Good speaking to you. Thank you.
Likewise. And viewers, thanks for tuning into this leg of the Talking Point.